So, if you have a lower credit score, are you getting a better deal on a mortgage versus somebody who has a higher credit score? The answer is no, absolutely not. Okay, there's been a lot of stuff that I've seen on social media, on the mainstream media about this topic, whether people have good intentions and they just don't know what they're talking about, or if they're just intentionally misleading people. To me, it really doesn't make a difference. They're still just spreading basically lies. I guess misinformation is the word that people use these days, but they're just lying. I'm going to show some charts. I'm going to talk through this, hopefully kind of like a level that most people can understand, because it is kind of complex. But what's happening is there've been adjustments and changes to loan level pricing adjustments by Fannie Mae and Freddie Mac. Okay, that's what happened. And no, if you have a lower credit score, you are not getting a better deal than somebody who has a higher credit score. What they did was basically tighten the gap of what those adjustments, or basically kind of like a penalty, if you want to think of it in layman's terms, for credit scores are. Now, loan level pricing adjustments have always been around. All right, this is nothing new in terms of how the mortgage rate works, how mortgage interest rates work. They've been around forever. So, for example, if you're buying a co-op, co-ops are really hard to foreclose on versus a single family home. So the interest rate for co-ops generally much higher than a single family home. If you buy an investment property and say you own a primary residence, you own an investment property as well, the interest rate for an investment property is high compared to a single family home. Why? Because if you lose your job, you're most likely to pay your mortgage on your primary residence versus the investment property. You might foreclose on that one first versus your primary residence, which is, statistically the case. That's why interest rates for investment properties and vacation homes are significantly higher than single family homes. So those are loan level pricing adjustments for occupancy status or for the home type. There's also loan level pricing adjustments for credit scores and for loan to value. Loan to value is just the inverse of a down payment. So if you have a 5% down payment, 95% loan to value. So I'm going to bring up some charts and just explain what's been going on in the media and what they're doing to mislead people, I guess is the best way to say it. So if you look at this chart right now, and forgive me because I'm going to have to look at the chart to try to explain it, but what they're saying is that if you have a higher credit score, now you're going to have a worse deal than somebody with a lower credit score. If you look at this chart, you look at the right-hand side of the chart, you'll see that there's two columns, one for 95% LTV and one for 97% LTV, meaning that you're putting 3% or 5% down on a home. This chart is what the old LLPAs are, penalties, if you want to call it that, versus what the new ones are. And if it's green, you're good. All right? It means it's been an increase. It's favorable in terms of if you're getting a mortgage, what your interest rate would be. So if you look on the two columns, regardless of your credit score, things are getting better. So right there, you just know that it's a lie perpetuated by the media. Okay? If you look in the center of that chart, all right, somebody with a 740 to 760 credit score with, say, 80% down, yes, they are getting a big hit. But it's not a big hit versus somebody with a low credit score. It's versus what the old criteria was. All right? So if you look at the bottom of that chart, you see a lot of green. All right? That means that people who have the lower credit scores are getting better deals nowadays. Again, there's a lot of reasons for that, or theories about why that's the case. The most important chart that's going to help you understand why you shouldn't be upset or angry or think that you wasted your time getting a good credit score is the chart that I have on the screen right now. Okay, this is, again, loan to value across the top, again, just the inverse of a down payment, and on the left-hand side vertically, you see credit scores. So let's look at the column at the top that says 75 to 80. That means you're putting down between 20 and 25%, all right, as your down payment. Then going down, the credit scores go down. So on the top is higher than 780, and then in increments of 20 going down on the left-hand side. Pick any column, and you'll see that the loan level pricing adjustment gets higher as your credit score gets worse. So it's plain black and white. I'll explain any of this to anybody who raises their hand and they say they want a deeper explanation, but all you have to do to understand that what you're being told by the media, that a lower credit score is beneficial to you versus a high credit score, despite the fact that you've worked so hard to be financially responsible, or you went into credit repair and now you're going to get a worse deal, it's not the case. Just look at the chart. Okay, this is the real chart that they're not showing anybody. The lower the score, the higher the loan level pricing adjustment, which means the higher the interest rate, but it's really pricing, and I'm not going to get into that on this video. Basically means your deal gets worse as your credit score gets worse. So again, any questions, feel free to contact me. I just wanted to try to clear up very succinctly or briefly what's going on and trying to dispel the myths that are being perpetuated out there. So if you have any questions, please feel free to give me a call and I'll be happy to answer them for you. Thanks.